So you have $100,000 to invest. If you invest in cash, you're looking at 2 units only. Right now, we're in an interest rate environment of 3 to 4% on your money. So now this 100,000, if we look at it purely from that point, instead of buying 2 units, that same 100,000 at 80% LTV, okay, will buy you 5 units, right? Now the question is, are you looking for current income cash flow, or are you looking for capital growth and appreciation of your money and minimization of taxation? So when you're at 80% LTV, the property should still cash flow for you and amortize the debt, right? You're using other people's money. You have 5 units to 2 units. Your return ratio based upon this, in this scenario here, you're going to have $2,000 a month coming in, right? In this scenario here, you're going to have $5,000 a month coming in, okay? In this scenario, you've got $100,000 worth of properties that are sitting. Maybe they grow a little, okay? But in the same scenario, now you've got 5 units that are amortizing with less current taxation, okay? And at the end of the day, instead of having $100,000 worth of properties, you're going to have $500,000 paid off by others. So the question is, are we looking for immediate gratification now, okay? Or are we looking for a vehicle to invest and grow our money and minimize our tax consequence in the process? So here you got 100,000, you're only growing at the market rate. Here you've got the amortization of $400,000 worth of debt. Okay? And at the end of the day, you're going to have a $500,000 portfolio instead of a $100,000 portfolio.
Why is there less taxation in that one?
Why? Because there's less amount. If he pays for the in cash, everything that comes out of it is income. If he buys it as investment and he has costs of funds on that property and he has it in a company, all these things should be corporate assets to protect them liability-wise. It's a balance sheet of a company. So the other thing, you don't want to hold them in your personal name. You want them in a LLC or a land trust. You want them ideally, when you're setting this up, you should have a non-registered member of the non-related member, minor member, to protect yourself from any claims. You can even go so far as to create a management company, have your own properties in debt to your management company. That way your management company has a premier lien on the property, first position lien on the property. Makes it very difficult for other people to take your assets. So here your assets are sitting. Yes, they're safe. They're chugging along. You're making your, 3, 4, 5, 6, 8%, whatever it is. Okay? And that's okay. Over here, you're dynamically growing your wealth. So the question is, do I need money now? Okay? Or do I want capital appreciation?
Why over there are you dynamically growing your wealth?
Why? Because you're taking the $100,000
right,
and you're putting $20,000 down on 5 different properties.
You could do it all at one go?
Right.
You can?
Right. So here you're buying $100,000, you're buying 2 $50,000 units. Okay? And in this scenario, you're buying 5 $100,000 units.
So if I had now $100,000, I can now buy 5 units in one go?
Depending if you have the financial wherewithal to support the debt, you have to qualify, obviously, right? You have to have other income and things, and that depends. Some small business owners, they don't show their income. So we have to look at each case fundamentally, on individual by individual. But at the end of the day, your $100,000 goes a lot further because we're still at relatively low interest rates over the last 100 years. So our predictive trend for interest rates is going to be up. We should lock in as much debt as we can right now. Right? Make sense? So in this scenario, you have 2 units that are paid for, that are kicking out regular income without any type of deduction, and you have $100,000. In this scenario, you're still cash flowing the properties, but you're taking that same amount of money and you're amortizing $500,000 worth of real estate, rather than just parking $100,000 in cash.
Why $500,000? How are you getting to that?
Why? Because 20% down on 500,000 is $100,000.
Right.
We're going to get the closing costs from the seller. We're going to go, hey, Mr. Seller, look, I want to put 20% down. I want 3% concessions from you for your closing costs, and make the deal.
Then you still have $80,000.
Plus, the difference also here is these units are only renting for around $1,000 a month, right?
Right.
A 2-2 could be 12 to maybe as much as $1,500 a month.
But that is a 2-2.
No, this is 1-1.
A 50K 2-2.
50K 1-1. That's 2 units at 50K 1-1s.
Right, but you can also get 2-2s at...
Más o menos.
Not really.
Not really.
So 2-2, you get more rent, you're getting more income every month.
And you're
then
advertising more
and
debt.
then you've kept 80K from the 100K.
Right.
Which now you can use for the next property. But
Right.
that can only come after you're showing some income on the first one and it's covering itself. And
If the guy's got money, he's going to qualify. I mean, it's not.
it makes
a big
no
difference.
sense to buy 2 with 100K where you could buy much more with less down, keep your money, get more...
Keep your cash. Cash is king.
And get more value what you're buying from.
I mean, when you're at historic lows of interest rates, locking in cheap money is crucial.
Right.
The rental market is not going to change. The people needing a place to live, people on fixed income, it's not going to change. Okay, even if we have a correction or a flattening of the market, people still need affordable housing. Right. This is affordable housing for people that are typically on fixed income. It's a real safe play.
Okay, thank you very much.
You're welcome very much.